Is the labor market cracking? A massive signal in bond market volatility just triggered. And is dollar liquidity stress starting to emerge? Massive economic data dump the past 2 days, tons of labor market data showing significant cooling, trade balance data with some very interesting numbers on unusual gold imports, ISM manufacturing report potentially indicating higher PPI inflation ahead, a stock from the headlines crushes earnings expectations, some worrying signs in bond market volatility, and again, potential dollar liquidity stress might be starting to emerge. We'll get to that at the end, but first, we're going to go through the economic data from the past 2 days. And I did my best to summarize so we can get through this quickly. Challenger job cuts. It's a private organization, puts out labor market data. We can see 85, basically 86,000 job cuts for the month of August. This is the highest reading for August, going all the way back to 2020. We also got productivity data. I will note the job cuts data is still not necessarily indicating a recession like we saw, for example, during .com or 2008. So still relatively subdued, but we're near the upper end of the range that we have been in going back the past 5 years. So definitely something to keep an eye on. And then down here we have productivity. So productivity, very simply, is the amount of output that you can get for a given input. And generally speaking, you want to see productivity enhancements on a aggregate economic basis. That means that your economy can produce more with less input. And so this is for the economy writ large. Higher productivity is a good thing. Now, the question becomes who gets the gains from productivity? Who do those productivity gains flow to? And we know it's not the average American, at least for the past 30 years. That caveat being said, we had labor costs rise 1% on a quarter over quarter basis. The estimate was 1.2%. So we came in lower than expected on labor cost. Productivity rose 3.3%. The estimate was 2.7%. This was a significant beat. Again, the red line shows the underlying index. Down here, we have the annual rate of change. Now, with all the AI talk of massive productivity enhancements, so far we have not really seen that. If anything, productivity growth has slowed going back to July, September of last year. We've been curling down on the 12-month rate of change, running at about 2% annual growth. So here is that productivity report. I will link to all of these in case one interests you. But here is another way to visualize the data, and that we can see, again, the red line shows from the same quarter a year ago. What is the change? We're starting to bounce in that regard. And then the blue bars show from the prior quarter, what is the annual rate of labor productivity? Again, quite strong at 3.3%. Now, we also got initial jobless claims today. The estimate was 230,000. We came in higher than expected at 237,000. Now, I do want to note, I'm going to zoom out here and show kind of initial claims going back all the way to the 70s, the late 1970s. We can see that the readings that we are currently at, the absolute level that we are at here, is still relatively low. However, during a recession, as you can see with 2008, with .com, and 2020, obviously, with a recession, you get initial claims start to go kind of non-linear. We have still not seen that. But again, there are definitely signs that the labor market is cooling. Here's yet another one. ADP private payrolls, again, private organization puts out labor market data. We can see that came in lower than expected, 54,000 payrolls created versus an expectation of 68,000. By the way, this is from Zero Hedge, and you can see this change between the job changer wage growth and the job stayer wage growth. This is indicating that the job changers are starting to get an accelerating amount of wage growth relative to job stayers. This was something that we really saw kind of in 2021, where you were really, as a worker, you were really incentivized to change jobs. So here is the JOLTS data, and we will go over here. I highlighted a few key areas. Now, remember with JOLTS, what you're looking at with a negative number means openings are going down. And so that reflects a higher demand, supply demand sort of balance relative to job openings going up, which indicates that, that particular industry is in desperate need for more workers, and there is not enough labor to fill those jobs. So hopefully that makes intuitive sense. The number of job openings decreased in healthcare and social assistance 181,000. Arts, entertainment, and recreation also saw a notable decrease in terms of openings of 62,000, mining and logging, 13,000, negative 13,000. The number of quits increased in professional and business services by 197,000. This seems notable. Quits decreased in construction. Again, construction is starting to pick up, it appears. That decreased, the quits decreased by 80,000. And in transportation, warehousing, and utilities, the quits decreased by 49,000. Layoffs and discharges decreased in professional and business services by 130,000. We had been seeing significant layoffs there, but increased in federal government by a small amount of about 5,000. So here is sector by sector. These are job opening levels and the rate. We're going to look at the change from June of 2025. So from last month to this month, the total private in terms of openings are down 138,000. Construction openings are up 64,000. Retail trade saw a huge decrease in the number of job openings, 110,000. Financial activities is growing. Openings increased 47,000. If we scroll a bit further down, healthcare and social assistance, massive decrease in job openings, 181,000. Arts, entertainment, recreation, and again, this is from last month to this month, a decrease in openings by 62,000. And of course, state and local government, a decrease in job openings by 56,000. So that is job openings. I do want to point out that when it comes to the employer or the sector, here is an interesting chart that was going around a couple weeks ago. And this shows the top employer in each state in 1990 relative to the top employer in each state of 2024. And you can see the dramatic shift in the structure of the economy, where manufacturing is still the top employer for parts of the Midwest and kind of the old Rust Belt. But in general, healthcare is just dominating compared to what it was even in 1990. Remember, the trade deficit started to really kind of grow in 1981. And so even by 1990, the top employer was still manufacturing for the vast majority of the population. So this is why kind of some sectors mean the data might mean more in terms of how the overall economy is going to be doing. We have kind of a domination of healthcare in terms of jobs for the vast majority of our states in the United States. There was a lot of hoopla about the JOLT data because for the first time going back to 2021, we see the unemployed level. This is the number of people that are unemployed as measured by U3. The number is much higher if you include discouraged workers part-time for economic reasons. But even using the headline data of U3, there's 7.24 million unemployed people in America, and there's only 7.18 million job openings. So we have more unemployed than we do job openings. Now, I did want to point out, though, that this data only goes back as far as 2001. But what you can see, the red shaded areas equal a recession. What you can see is that from basically 2001 all the way up until 2018, the number of unemployed people was higher than the job openings by a large degree. So while this cross is significant, it is, once you zoom out, that this perspective, hopefully, and again, same thing with the initial claims data, that while they do appear to be kind of moving higher and the labor market is certainly cracking and starting to cool, you can see that initial claims are still far below what they are during a full-blown recession. So we also got ISM Manufacturing. We're going to go through that report right now. That is over here. So a couple key points that I highlighted from this. Remember, ISM is a Private Organization Institute for Supply Management Purchasing Manager Index. This is a survey of, in this case, manufacturing companies. The overall economy continued to be in expansionary territory for the 64th month after 1 month of contraction in 2020. They note that a manufacturing PMI above 42.3. Now, normally the kind of baseline is 50, but what they're saying here is that when manufacturing PMIs are above 42.3 over a period of time, that generally indicates that the overall economy is expanding. 2 of the 4 demand indicators improved, with new orders and new export orders showing gains. Regarding output, the production index returned to contraction, and the employment index edged up slightly as panelists indicated that managing headcounts is still the norm at their companies as opposed to hiring. Again, going to that kind of cooling labor market. Finally, inputs. This is supplier deliveries, inventories, prices, and imports on net declined further into contractionary territory. I did want to note a couple things from kind of the at a glance chart that we can see here. Overall, from last month, the overall PMI index did rise ever so slightly. It is still contracting below 50, but it is rising from last month, 48.7 versus 48. New orders picked up quite a bit, 51.4 versus last month, 47.1. This is in the direction of growth. Prices are start to cool off. Now, we'll take a look at that and why this matters so much. We'll take a look at that chart in a second. But prices did start to moderate a bit, 63.7 versus 64.8 last month. However, the overall direction is still an increase in prices. New orders, again, here you can see the percent of respondents that are saying a higher number, the same number, or a lower number. And what we saw during the last ISM report that we covered was something very similar to this, where it was kind of equally split between some firms reporting higher and some firms reporting lower, and then a good amount in the middle that are just reporting the same. That is what we see basically for new orders. That is also what we see for production, although with a slight bias towards lower. Employment, we see a definite shift towards the lower direction. On net, this is a negative 13 reading for employment. Again, that cooling labor market, that tightening labor market. And then finally, prices. Again, this is showing a bias towards higher. 60% of the respondents are reporting the same, but reporting higher prices, 33.5 versus only 6% reporting lower. So the reason that this matters, here we're going to look at the data, the chart, for those various major components: prices, new orders, and employment. Again, I put a baseline at 50. That is kind of the baseline for contraction versus expansion. We can see prices are definitely in expansionary territory. Employment has been in contraction really for a long time, with brief spikes up to like just above 50, but generally the employment reading for the ISM manufacturing has been pretty anemic. But what I want to point out is new orders for really the second time going back all the way to 2022 started to go into expansion territory. And so new orders generally with the business cycle, as new orders are picking up, that indicates that the business cycle is starting to accelerate. And so, you have the Fed cutting rates. Some people have been pointing out that they've never really started to a rate cutting cycle when new orders are above 50. But the other thing, of course, that is very notable with this chart is prices. So you can see a dramatic spike in the prices. And the reason that this matters, here is the producer price index, the PPI, with a 7-month lag. And then we have ISM manufacturing prices. So ISM, you see inflation before you see it in PPI. So that is what this chart is looking at. We can see, for example, the top here in ISM manufacturing prices, uh, coinciding with a 7-month lag on the PPI. So, what prices are doing today can tell you what PPI is generally going to do into the future. You can see they bottomed. The 7-month lag appears to be pretty good for timing the bottoms and the tops. It's not perfect correlation, but I think useful enough. And what this is indicating, even though prices have cooled off over the past couple months a bit, they are still up notably. And we have PPI running at 3.3%, yet another inflation metric above 3.3%. So we also got trade balance data. And again, the Fed is talking about rate cuts with PPI above 3, core CPI at 3.1, PCE running at, I think it was 2.9 core PCE. So, these Fed cuts need to be seen in that context. We got trade balance data, and there was some interesting data here. July imports were 358 billion. This is 20 billion more than June. The July increase in goods and services deficit reflected an increase in the goods deficit. Remember, we run a massive goods deficit and a slight services surplus. Goods, that is mainly what the tariffs are meant to try to address, is our goods trade deficit. The goods deficit increased by $18 billion. And we had a decrease in the services surplus. The slight surplus that we do have came down by 1.1 billion. Year to date, the goods and services deficit increased by 154 billion, or 30% from the same period in 2024. This is a massive increase. And I've always said that this administration has their work cut out for them. Exports increased 103 billion, or 5% only. So you can see that the goods and services deficit increasing at 30%. However, our exports are only increasing at 5.5, and imports are increasing at 10.9. So they definitely have an uphill battle. Here you can see exports decreased in the month of July, and imports increased. So again, driving that deficit wider. But what I wanted to point out here, this is exports of gold increased by 2.9 billion, but look at the imports of gold; those surged by 9.6 billion. I'm not really sure who it is that is buying all of this gold, but this is like the third or fourth or fifth time that we have seen just a surge in gold imports, which is definitely interesting, or you could say confusing, or maybe suspicious. Like, what's going on with the gold? Why is, in fact, the first quarter current account report that we got for the first quarter of this year showed part of the reason that we had a GDP contraction quarter over quarter was because of gold imports. We imported so much gold in the first quarter of 2025. We imported so much that it dragged GDP, which is the overall aggregate output of the U.S. economy. It dragged GDP into contraction. That's how much gold was imported in the first quarter. And again, we go through these reports every month. This is like the third or fourth time where you've seen a substantial increase in gold imports. Consumer goods, by the way, increased 1.3 billion. So here's the chart showing the balance of trade. And again, what's important here is that it is starting to reverse. So there was the tariff noise, right? A bunch of front running as imports surged. Then the tariffs went into effect. All of that reversed, and we got a pop where the trade deficit improved. Well, it is starting to head lower again. And finally, as a share of GDP, we can see that the trade deficit as a share of GDP is running almost at 4%. This is, again, the Trump administration has their work cut out for them. Some of the structural issues with, say, the capital and financial account surplus that the U.S. runs are just going to be very difficult to really balance trade unless those flows, those capital inflows, are attacked. We got a major beat from American Eagle. I just wanted to cover this because it's been in the news. We can see that American Eagle is up 38% over the past week. If we go to the daily chart, we can see they gapped up on very, very good earnings after the Sydney Sweeney ads that they were running. Now, here's that bond market volatility index. Big shout out to Fentro. He actually asked about this in the Discord, why I never covered it. And the reason was because here it's inverted, by the way. So as it is moving lower, the line is going to be going up. And that's what was happening. We had significant bond market volatility here in, say, March and April of 2025, but in general, it's been moving lower, indicating lower expected volatility in the bond market. So, really, nothing concerning, nothing really worth addressing. But, however, we just got a sharp move higher in the move index. Again, it's inverted. So we moved from about 77 all the way up to 90. Now, according to Harley Bassman, who created this index, the danger zone is around 130, which we can see we have reached a couple of times. By the way, one of the times coincided with the low in terms of the stock market during that Liberation Day kind of chaos where bond yields were just skyrocketing. That is one time that we got significant kind of chaos level in the move index. This is basically the VIX index for the bond market. And what we saw is, again, a sharp move higher in expected bond volatility from 77 to 90. And generally, I marked some moves or some bottoms in the move index where the move index starts to move higher, and it sets a local low. Well, just about every time that you can see a notable bottom in the move index and then a sharp move higher, generally speaking, you can see that at least going back to early 2024, that has coincided with a sell-off in the S&P 500. So here is the dollar liquidity picture that we had mentioned is might start to be getting concerning. We can see again the blue, green, white, and red lines. This indicates how the Fed sets that federal funds rate that you hear talked about so much. The discount window is kind of the upper band. IORB is the green, and then reverse repo is a way that they try to set a floor in the overnight interest rate for dollar loans. That's what we're looking at here is kind of the overnight US dollar markets. And again, the cost of a dollar is the interest rate on an overnight dollar loan, basically the shortest duration of a loan. In yellow, what we're looking at is what's called SOFR. This is the secured overnight funding rate. And what you can see is that there is volatility in the SOFR rate relative to the Federal Reserve rates that are relatively constant. And the reason is SOFR is much more of a free market. So if there is a ton of demand for overnight dollar loans, but very, very little supply, well, you're going to get a spike in SOFR because, again, it's functioning off of kind of more supply and demand dynamics in the actual overnight dollar markets. And what we're looking at in purple here is the relative spread between that kind of free market interest rate for an overnight dollar loan, which again indicates the supply and demand, and if there's an imbalance, indicates which direction. And then in purple, what we're looking at is that free market kind of interest rate that reflects supply and demand for dollar loans on an overnight basis relative to the white line, which is the federal funds rate. And what we can see is that we are, according to yesterday's data, this only comes out once a day. According to yesterday's data, we are starting to approach 6 basis points. You can see SOFR down here spiked, and it's almost at IORB, which is at 4.4. SOFR yesterday, at least, was 4.39. So we are basically at IORB. You can see that this has happened other times. The vast majority of those times were coinciding with quarter end or month end. There are some bank rebalancing and all sorts of wonky mechanics that the banks need to do, window dressing and all that sort of thing. So you generally see some amount of stress quarter end, sometimes month end, and certainly year end. You see stress as we can see here. SOFR spiked above the discount window rate, which, if that had been prolonged, would indicate the Fed is losing control of the overnight dollar markets, of the plumbing of the financial system. What we can see is that a 6 basis point spread, meaning SOFR is 6 basis points above the federal funds rate, this is starting to indicate some stress. It's not full blown chaos. Everything is melting down. And of course, this could always reverse. Hopefully today, we see that because when there is dollar liquidity stress, it can manifest quite violently, like we saw in 2019 with the repo rate crisis. I will link a video at the end that goes into all of this in more detail, kind of the plumbing of the financial system. But a reason for this, and we have been flagging this for a month and a half or so, is what's called the rebuild of the TGA. The TGA is the Treasury General Account. This is the government or the Treasury's checking account. And when the line is going down, what that means is money, as you can see in the middle scale here, 800 billion got spent into the economy. So their checking account balance decreased, meaning that money got released out into the economy, into the financial system. The opposite is also true, which is when the line goes up, they are sucking money out of the financial system, out of the economy, and it's basically just getting sterilized and put in a checking account. This was in part due to the debt ceiling and some other dynamics there. This was expected that they would be rebuilding the TGA, but from mid July, they have successfully removed about $270 billion from the financial system. You can see the TGA was running at $300 billion balance. It is now at $590 billion. So they removed already $270 billion from the financial system. Here in white is the reverse repo. And the reverse repo you can think of as basically a pile, a tank of sterilized excess dollars. We printed so much money during the 2021. We printed so much money that to prevent that money from, we overprinted. And so to prevent that kind of oversupply of dollars from reaching goods and services and to some degree even assets, to prevent that and causing even worse inflation, what they did was establish this reverse repo facility, which was basically a way to sterilize kind of excess dollars. So as this is coming down, what that is indicating is that that tank that is full of kind of that battery of sterilized excess liquidity is coming down, and there is no the tank of kind of excess dollars to go to kind of buffer liquidity strains is basically nothing. It's only at $17 billion. The RRP has been being drawn down for over a year now, and it is basically empty. We are at 17.9 billion. Well, they still have another 200 billion or so, 250 billion or so to rebuild the TGA. Last I heard, they were trying to get to 800 or 850 billion dollars. We're only at about 600. So you're talking another, hundreds of billions of dollars that need to be removed from the financial system. And again, that kind of battery or that tank of sterilized dollars that you can go to in an effort to rebuild this balance, well, it's basically empty. It is at only 17 billion. So finally, here is SOFR Fed funds. And kind of what I wanted to point out is since the TGA rebuild has been happening, going back again to kind of late June, early July, we can see that the SOFR Fed fund spread, which is what we were looking at here, this has been starting to kind of head in an upward direction, especially as the reverse repo has been being drawn down to basically nothing. We can see that, SOFR Fed funds is starting to indicate some potential dollar liquidity stresses. So, the DXY, you could see a squeeze in the DXY if you get a full-blown liquidity crunch or liquidity squeeze. It could be quite violent, as we saw in 2019. I will zoom out and show what happened in 2019 for those that are not aware. Again, we did a whole video on 2019 as well as the general workings of the overnight dollar markets. But you can see the SOFR, again, the free market rate based on supply and demand of dollars, SOFR reached it actually reached an even higher level on an intraday basis, but on a daily close basis, it reached 5.2% when the federal funds rate was only 2%. So this is the repo rate crisis of September of 2019. This was indicating a severe shortage of dollars. The supply was far too small compared to the demand for dollars. So what you got is a repo rate crisis, where it actually spiked on an intraday basis 900 basis points. And you can see that SOFR Fed funds, as measured by the purple line, just really blew out. At one point, on an intraday basis at least, you could see that SOFR Fed funds just completely ripped higher. I mean, it's going off the chart. So that is what can happen during a liquidity crunch. And the repo rate crisis is kind of one of those things, one of those crises that arguably could have gotten very, very, very bad if it were not for some quick actions and the ability to get this under control. Now, we know, by the way, what happened here when the federal funds rate got cut to zero and their balance sheet exploded higher. Remember, the Fed prints bank reserves, and those are sent to the banks. So dollar liquidity got injected to a massive degree in early 2020, shortly after the SOFR repo rate crisis. So I will link those videos at the end that go into more detail, but we definitely need to keep an eye on this because both the MOVE index and bond volatility, like we covered with UK and France, to some degree Japan as well, bond markets all around the world, all around the developed world, are showing cracks. We're getting some definite cooling in the labor market here in the US. And of course, that TGA rebuild and kind of a dollar liquidity stress, we definitely need to keep an eye on that because that can be major. So, anyways, hopefully that was helpful. I will link all the reports in the description and I will catch you in the next one.